Hello, this is Chuck Carnavan. I'm the Chuck in the Markets Up Chuck. And today's blog was titled How Sweet Is It? And we're going to look at a little bit of a different kind of company today we have looked at in the first part of this week. We're going to kind of stick with the idea of investor education here, and the theme of investor education. We're going to take a look at a company called Hershey, which everybody knows, the Hershey chocolate and the famous Hershey Kiss. Bottom line is Hershey is a very excellent old line company that's had about almost a perfectly average performance as a company. Their historical earnings growth has been about 7.6% for the last 20 years. You can see that clearly by the green line with the white triangles. It's been very consistent, I might add. A down year every now and then. They have their, a little bit of lumpiness, but generally speaking, their earnings record has been a very consistent grower at about 7%. They pay a very attractive dividend of 3.3%, as you can see by the light shaded blue area. Keep in mind it's paid out of the green area and just stacked on top for visual perspective. This company has commanded a normally attractive price-earnings ratio. Normal PE has been about 21.3, as you can see by the blue line. However, keep in mind this is also through a period where stock prices have generally been overvalued until we hit the recent recession, in 2008. And of course, I also want you to notice that, in 2008, the company actually fared pretty well. Even though we had a recession, their stock price was vulnerable because they were overvalued. But I would argue now that, Hershey's is trading at least at a reasonable price-earnings ratio of approximately 18. When you look at Hershey's long-term track record over the same time frame, and a couple of points I think that need to be made that are very, very important. First of all, this company has an excellent dividend record, and because the valuation is at least on a historical basis, lower than normal today, you can get a 3.3% yield, where in 1991 you'd start out with a 2.5% yield. But I want you to notice that they've increased their dividend very consistently, year after year throughout this whole 20-year period. We had 1 year in 2005 where they did reduce the dividend, but the dividend has increased dramatically. And I also want you to notice that the rate of return to shareholders is 7.7% annualized, compounded annualized, has correlated very closely to their earnings record. In the long run, earnings drive market prices or determine market prices. And they've done about what the market did, a little better than the market at 7.7. The market did about 6.6. But in many ways, you would call Hershey a very, average but extremely good, although average grower, an extremely high-quality company, but yet an average grower. The company does have a lot of debt on the balance sheet, and that's something that I think, prospective investors should look at closely, because that's obviously a very important consideration. So, there you have it. Hershey's has been an average growing company over the years, but it's rewarded shareholders very well for the quality that it gives. It's currently trading at what would be considered a, normal or a low normal valuation. I might even argue it's fairly valued, but it's certainly not overvalued at this point, and it's certainly not dramatically undervalued. But it has a nice dividend yield, and is forecast to continue to grow into the future at about its historical growth rate of 7%. So it could be very fairly valued and attractive, as we look ahead. This is Chuck Carmel saying thanks for listening, and I'll talk to you again tomorrow.